So the markets are making new all-time highs. And according to the markets, we are now doing better than we did before this pandemic happened. But is this really true? Or will we see a stock market crash right now in September or October? Will we see a stock market crash in 2020? That's what we're going to talk about today. So let's take a look at the markets and let's see where we are. So I want to show you what happened here ever since this pandemic hit. So, the coronavirus scare, this is when the market were crashing down. And let's actually take a quick look of where we are right now, because we are making new all-time highs. So the S&P 500 that I'm looking at right now is up, 64% since the pandemic hit. Making new all-time highs, so apparently we are better off. The same here for the NASDAQ. I mean, look at the NASDAQ. This is February 2020, the pandemic hit, and then we are now, my gosh, I mean, it's unbelievable. Let's see how much the NASDAQ jumped up, 83%. That is absolutely crazy, isn't it? We also have individual stocks like Apple making new all-time highs. We have Tesla making new all-time highs. We have Amazon all making new all-time highs. So the question is this really sustainable, what is happening here? Are we now really better off than we were before the pandemic, or are the markets about to crash? So let's take a look at the facts, because as you know, this show is all about the facts. Now, in November, as you know, it's 2020, there are the presidential elections, and that's a significant event. So let's take a look at what happened historically in the 3 months leading up to the elections. And this is where I found this blog, Isabel Net, and here's an image from Ryan Detrick, so credits where credits are due. I didn't create it. But as you can see here, over the last 23 elections, these are the results of what the markets did in the 3 months leading up to the elections. And this is what we have right now, right? We have September, October, November. Now, as you can see, 14 out of the 23 times the market went up. 9 out of the 23 times the market went down. But as you can see, the moves here are not really significant. You see, the moves are always 2%, 3%, 3%, so it's not a whole lot. There's one exception. Yes, that's the 2008 crash. This is right before ex-President Obama got elected. The markets were down almost 25%, but we don't count that. That was a unique situation. Other than this, the losses, if you can see this here, the losses are less than 3.5%, and the gains are anywhere between 2.5% and 8%. So, based on this data, we can expect the market to drift higher in the next few months. And I'm saying drifting higher because right now, if you look at the markets again, they have not been drifting higher. They have been skyrocketing higher here, as you can see. Anyhow, so let's go back to this. Why is it that usually markets going into the election are not really moving a lot? Well, there's a very simple explanation for this. Obviously, President Trump wants to be reelected. And right now, he has a great story to tell. He can say, look at the markets. They are at all-time highs. And you know what he will add? I did this. Anyhow, I don't care what political affiliation you have. It seems that the stimulus packages, as well as the Fed measures that they implemented over the past few months, seem to work. So honestly, Trump would be stupid to rock the boat now. Yes, we still have a conflict with China, but that's piddle-paddle. It's like two girls in a sandbox saying, you're mean. No, you're mean. You're ugly. No, you're ugly. I mean, there's not really trade war going on right now. Yes, we have the TikTok stuff, and even China right now seems to focus on India as another partner to fight a little bit. And you see, I don't think that Trump will do anything that could send the markets sharply lower. Let's go back to this, because that would decrease his chances of being reelected. This makes sense thus far? Okay. Anyhow, I also don't see any other major events that could rock the market. Let's take a look at the economic reports. So here we see the economic reports of the past months. And you see here is what was forecasted, and then how are these economic reports are actually coming in. And this is in the beginning of August. And you see green means better than expected. better than expected, better than expected, better, 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 better. You see green, 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 green. Yeah, there was a little bit of red, but then we have all green, overwhelmingly green, as you can see. So it seems that the economic is doing pretty well. Now, another reason why I believe that we will probably not have a market crash, but there is something that is coming up, and I want to show it in a moment. But let's talk a little bit more about the current situation. Pretty much all companies in the S&P 500 reported earnings for the past quarter, for quarter two. And 84% of the companies reported better than expected earnings. So all of this is good news, and it seems that we are handling the pandemic pretty well, at least economically. So what could send these markets lower that are just skyrocketing? Again, we are looking at the S&P 500 here. One word: profit taking. You see, no market is going up forever. At some point, there will be some profit taking and the market will drop. The key question is, how much will it drop? And that's what we're going to talk about right now. I'll show you how much I think the market will drop based on profit taking. But before we go there, is this making sense thus far? Are you enjoying this video? Because if so, do me a favor and click on like really quick, and then we can continue. Okay, very, very cool. So let's jump back to the screen here. And there are two tools that I like to use to get an idea of how much a market can drop. And the first tool that I like to use are Fibonacci retracement. Now, I'm not an expert in Fibonacci, and I'm not claiming to be an expert, and there are probably much better ways to do it. But here is how I do it, how I use Fibonacci. First of all, let's go back of when the market, let me reset the chart here, of when the market hit the low here. There we go. See, what I like to do with the Fibonacci tool that I have here, we're going from a low to a temporary high, and then we see the Fibonacci retracements here. And we see that here, when the markets bound back, they retraced to the 0.5 level. Again, not an expert. If you want to learn about Fibonacci, there's probably better people to learn about this. But it helps me to get an idea how much a market could retrace. Because if you look at this, we always have that the market is going up, and then we have a retracement. And the market is going up, and again, we are using the Fibonacci tool. Market is going up. How much is it going down? Here, it is not quite hitting the 0.5%, but it's hitting another level, the 0.236 level. So these two levels are pretty significant, the 0.5 level and the 0.236 level. Okay, let's take a look a little bit more, and let's especially take a look at the current market conditions. So again, we can apply the tool whenever you have a temporary low to a temporary high, and you see right here, the 0.5 level was hit, the 0.236 level was hit. Anyhow, you get the idea. So let's apply this right now to the current market, where we are right now. So there's two ways to do this. We can take a look from here, where we had this low, to going up here. And as you can see, we have the 0.236 level at 3,450 around. And then we have this level here at around 3,300. Actually, I personally believe it's a better way to look at this from this recent retracement that we had. And this is what I want to use here to show you my market prediction of what will happen. So as you can see, the 0.5 level here is at around 3,400. Let's actually mark this on the chart, because I feel that during the next profit taking, we might go down to the 3,400 level. And I want to write this down so that you see exactly what I'm marking here. So 3,400 in the S&P 500. Now, it can be that the markets just retrace a little bit. And as you can see here, this would be if you're going down to the 0.236 level, it would be to around 3,500. So let's mark this as well. And let's say this is another possible level. So 3,500 in the S&P 500. Okay, now I will also show you a second tool that I like to use. So let's remove this Fibonacci tool for now, because otherwise it gets pretty cluttered, doesn't it? Anyhow, thus far helpful. Again, there will be some profit taking. A market does not go up forever. I mean, just look at what the chart is telling you. And I mean, the charts don't lie. The market is going up, retraces. 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 This is always happening. And again, the key question is, how much does it retrace? Now, second, the other tool that I like to use is a concept that I learned from my friend Rob Booker. And it's the concept, let me just show it to you, of the so-called missed pivot points. So pivot points are an important concept, right? A pivot point is the high plus the low plus the close, and you divide this by 3. It's a great concept, and here Rob likes to use at missed weekly and monthly pivot points. And by missed pivot points, he means pivot points that have not been hit by a retracement. And you see they're pretty close to these levels that I found based on the Fibonacci retracement. There's one and there's another one. So they are slightly lower. And if you look at this, it is very likely that we do see a possible retracement here to the around 3,400, 3,350 level, or here 3,480. You get the idea. These are levels that the market is likely to hit. So the question is, how much will the market retrace if it does? So let me just summarize briefly what we talked about right now. Is the market going to crash in the next 3 months? Now, everything is possible, but based on my analysis that you have seen here, it's not very likely that the market is going to crash. And by crashing, I mean going down by 10, 15, or 20%. Yes, I absolutely believe that we could see a correction to these levels, but based on the analysis that I've shown you on this video, it's more likely that we will keep drifting higher and maybe have a retracement, as I've shown you on the chart, maybe to the 3,500 or 3,400 level in the worst case scenario. And until then, we'll probably just not rock the boat and slightly drift higher here. Is this helpful at all? Let me just ask you this, because if it is, and if you enjoyed this video, make sure to like it. And if you want to see more videos like this, then do me a favor and click on the subscribe button. And also click the little notification bell, because this way you get notified whenever I release a new video. And also remember to share this video, and I'll see you in the next one. Hey, talking about the next one, there's probably a few videos popping up on the screen right now. And click on any of these and I'll see you there.